Hi, I'm Pattu from freefincal. In today's video, let's talk about gold versus silver with respect to investment returns and risk. As of now, there is no silver ETF in India, so a retail investor cannot directly participate in silver reward and risk like they can in gold, but hopefully that might change. And some of you may remember last year SEBI allowed multi-asset funds to hold commodities up to 30%, and this includes, there are several commodities listed, and this includes silver as one commodity. Previously only gold was the only commodity allowed, so things might change in future. Anyway, this video is only academic in the sense that you can't really go ahead and invest in silver, but I made it because whenever there is a discussion on gold returns, someone will always say silver has got more upside, silver has got more potential, silver has done better, and so on. So let's have a look and see how this has fared. So as you have noticed, I have not been regular with respect to posting videos. There are two reasons for this. One is I'm busy with my coursework. I'm almost done with my semester. I should be free in the next few days, and after that it will be regular. More importantly, I will be able to post Tamil videos more regularly. I'm sorry I have not been able to do that at all for about a month or so. So let's get to this. So the first thing is the movement of silver in INR and gold in INR, both of it per ounce. And this is normalized from the 1st of January 1979. By the way, in this article, in today's article, I think I have posted it in the community tab. If you scroll down all the way to the bottom, there are several interesting references, the data sources, and also several interesting charts. For example, Dow Jones to silver ratio, Dow Jones to gold ratio, gold to silver ratio, the 100-year silver chart, and so on. And also I have linked an interesting article on what are the main differences between the gold demand and supply factors and silver demand and supply. You can see that in this gold slash silver price ratio link, you can see that. And so let's get on with it. So this is the normalized graph in INR of silver and gold. Silver is black, gold is red, and they are normalized, not only normalized, but also they are plotted in log 10 scale, and that's why you have this funny looking y-axis. So every 0.5 is the same. So if any point up to from 0 to 0.5, this up movement is the same as the movement from 0.5 to 1 or 1 to 1.5 and so on, like in every log scale. Now, if you look at this in INR with the exchange rate multiplied, the volatility of silver is not quite apparent. When you change it to USD and look at it in USD, you can see how volatile silver has been, the red line, compared to gold. There are many factors for this. One of this is silver is an industrial metal, not only a precious metal like gold. The most of its demand is coming from the industry, and because of recessions and economic difficulties faced by a country, then the silver price can go down. So that's also another issue that among the several issues, this is one of the key issues. Alright, so now let's get on with our usual rolling risk and rolling return charts. This is the rolling return over 5 years. You have almost 6,000 data points there. The brown line is silver, the gold is yellow. You can see that sometimes silver has outperformed over 5 years, but you can also see the spread between the lowest return and the maximum return here, minimum return to maximum return. That spread is much more for silver. That means the risk is much more. And if you look at the rolling standard deviation, which is the daily volatility, a measure of the daily volatility over 5 years, you can see that the silver line is on the top and it's almost twice as that of gold. So the daily ups and down movement of silver is twice as much as that of gold. Gold itself is almost as volatile or more volatile than equity from time to time. So silver is basically double of that. And I have also shown similar rolling return data for 10 years, 15 years, and so on in the article. I will skip that here and show you the 10-year rolling returns, and you can see the ups and downs movements here, and also again silver is much more volatile, and you can also see this over 15 years. Sometimes silver has bet gold over 15 years, but not always. And finally over 20 years, you can see the ups and down movements are significantly more volatile. Even over 20 years, you can see the spread in the return. It can 20-year return about 3 or -3 or 4% is atrocious. I mean, even for gold, 20 years can be very low, and sometimes it has been very low in INR as well. So the basic message is that gold, or I should say silver, is twice as volatile as gold, but it does not provide the associated benefit. Sometimes it provides the benefit, sometimes it does not. So anybody who wants to invest in gold, then they should be considering, either they should consider trading or they should consider tactical entry and exit. And of course, in this video, I'm not talking about emotional, psychological, societal value of buying gold or silver. That's not what I'm talking about. I'm just talking about the investment returns and risk. I'll catch you later. Bye-bye.